Hello and welcome back to the Self-Wealth Real Estate Podcast with your host, Luke Boyaron. Today I am interviewing Rob Maver of Calvert Home Mortgages. Rob is a friend and also a senior underwriter at Calvert Home Mortgages. We do a lot of business with them and Rob underwrites all of our files pretty much. And today we're going to talk about what Calvert is, what they do, how they can help investors, but also about mistakes that people make when borrowing private money, mistakes that are getting people into trouble in the flipping and real estate investing community that Calvert has seen since the market shifted, and also what people are doing to be successful. So listen in. I think there's a lot to learn from this, and thanks so much for listening, as always. Hello and welcome to the Self-Wealth Real Estate Podcast with your host, Luke Boyaron. Today I'm interviewing Rob Maver of Calvert Mortgages. Rob, welcome to the show.
Thanks for having me, Luke. Awesome to chat.
Rob is, I guess, the underwriter who works on our files at Calvert, but also at this point he's become a friend, and we talk more than we should. So, Rob, can you give us a bit of background? What did you do before you got into real estate lending?
Oh, we're going there already.
Kind of starting that
intro. I tend to shy away from my life pre-business because I don't want people to punish me for it. But I used to play football professionally in the CFL for 10 years, so that was a lot of fun. I was always trying to figure out what I was going to do after, because in the world of professional football, you hear about many cautionary tales, guys sleeping out of their cars, getting divorced, things not going so well as soon as the game checks dry up. So I was always trying to figure out what the next thing was, and fortunately for me, I found my way in the lending space about 6 years ago, so it's gone pretty well since.
Now, Rob, I don't have any Grey Cup rings. Do you have any?
I have 2 Grey Cup rings, 2-time Grey Cup winner, 3-time Grey Cup loser. So I know what it's like to lose the game. It's the worst feeling. And I just kicked the ball, so it's not like I was putting my body on the line like other guys were, but the pain of losing is significant. The feeling of winning is pretty good too. But whenever I like to humble myself, when somebody says, oh, do you have Grey Cup rings? It's like, yeah, I've lost more of them than I've won, but the rings are fun and they sit in a safe in my home office.
Nice. Well, I actually think that fits a little bit of what we're going to be talking about today, because we are going to be talking a little bit about wins and losses.
Yep.
And how to do better and avoid the losses, minimize them at least.
Yeah.
Now, the good thing is when you're talking about losses, you're talking about losing when you're already in the finals. So, it's kind of like, oh, I lost. I only made 50 grand on this flip. That's kind of what you're saying. I only made 50 grand on this flip instead of 100 grand on those other ones. But it's not like you're, the last one in the league, all right, at the bottom. So,
right.
All right. So you played 10 years in the CFL, and then you just decided, I guess I'm going to lend people money. How'd that happen?
Yeah. So I was always looking for that next thing. I thought I was going to be in sportscasting for a bit. Then I thought I was going to be in law enforcement. So I went all the way through that process, got down to the final interview. Then a buddy invited me to work on a little startup company with him, and it was in vehicle sales, kind of like Carvana, back in 2018. Online vehicle dealership, virtual car dealership is what it was. And he asked me to come help out with the BD side of that. So I said, sure. Took a deep dive into what we were working on there, and I realized that we made 3 to 5x on the vehicle financing versus what we did on the car sale. So I said, well, is there an opportunity to channel that somewhere else? So we looked into the mortgage space, figuring out there's ways that you can pull money out of cars for down payments, as crazy as that sounds, or fix TDS, or get it off your bureau entirely if it's messing up your ability to qualify. So we onboarded a few hundred brokers for that. It was pretty successful. And the people that owned the MIC here at Calvert still own another technology company. So they were, there were some synergies there in us working together. I shouldn't talk too much about that. Then I met our VP, Jesse Bobrowski, because we were doing some work together. And we did a trip from Calgary to Edmonton. And that was in 2018. Spring of 2019. And the whole drive up to Edmonton, I was asking him questions about the private lending space, And then the whole drive back from Edmonton, I was demanding that he give me a job. So they took a chance on me back in 2019, wound up going back to school, taking the appraisal stuff, broker stuff, blah, blah, blah. Really went at it hard because I'm not gifted enough to not give something my full effort. And it's afforded me the opportunity to work with awesome people like yourself and the Cash House buyer team. So I'm extremely fortunate.
Awesome. Well, we love working with you. I recently actually went to a Buffalo Bills game with Jesse, which was a good experience. He's a good guy.
Yeah. He's all about excitement and having a good time and making business effortless. That's his big MO, is making it easy to work with people, and he's a good guy.
Yeah, you guys are good at that. All right. So, what do you do at Calvert?
I am a senior underwriter, manage a team, and our job as underwriters, basically it's a fancy word for loan officer, if you will. So we work with mortgage brokers, we work with real estate investors and some borrowers directly. We intake applications, we review the file to see if it fits our lending parameters, and more importantly, are we giving the client a service? So do we see financial benefit for them in the deal? And if so, we'll structure a deal. Calvert Home Mortgage is a MIC, a mortgage investment corporation, so we are an alternative lender. So we're not your typical bank. So if you're looking for your 25-year to 30-year amortized loan at 5 to 6%, we're not the lender for you. We specialize in short-term lending opportunities where people are buying homes and flipping them for a profit. People are buying well and selling it or refinancing it with lesser down payments, bridge loans, some debt consolidation stuff. Anything short-term that doesn't fit with your conventional institutional lender is probably going to be a fit with us. So we kind of structure creative loan files to see how we can help people and also make sure that we're producing a risk-measured return for our investors at the same time.
Absolutely, because you guys, if I wanted to, for example, as an accredited investor, I could invest in your MIC, right?
You could. That would preclude you from borrowing from us as well, though. Not you specifically, just generally speaking, an investor cannot be a borrower because you can't have your cake and eat it too, so to speak.
Makes sense. Yeah.
It's a conflict.
Makes sense. All right. Well, I mean, some of this is going to sound like I'm hyping up Calvert.
Yep.
I don't know. Are you allowed to say this? I believe I'm your biggest borrower in Ontario. Is that correct?
You are, yes. Yeah, I mean, you can admit that. It's up to you whether or not you guys want to leave that in. But yeah, you're a fantastic client to work with and your team, and we're fortunate to do a lot of business together.
Well, the reason I'm saying that is because I work with you guys because it's actually a really good option for us as flippers. You guys make it really easy to borrow. A few of the things I like, obviously there's flexibility in how much to put down. The rate is, I find, reasonable, even compared to finding private individual. When you put, a decent amount down, 20% down, for example, it does get more expensive when you put smaller amounts down, but you also have that option, which we've used sometimes, depending on cash flow situations, to put, smaller amounts down, pay a higher interest rate, same fees, but pay a higher interest rate, but you can get into a deal with a lot less down if the deal makes sense. There's the cost of the appraisals, which almost every other lender requires an appraisal. And in my experience, I don't know if we've ever had to actually get an appraiser on site. You guys do kind of drive-bys to confirm, I guess, the house is there. And you guys do desktop appraisals, based on the pictures from your office. Because you have in-house appraisers, essentially, is that?
We have 4. So we have 2 that are designated with the AIC. Our other 2 are designated with Scenaria. And you hit the nail on the head. We do desktop appraisals. Sometimes we're making, EAs or HCs, so extraordinary assumptions or hypothetical conclusions on what the property is going to look like once it's complete. And then we do direct comparison approach desktop appraisals where we have our access to the MLS, we take the information on the property, we make our adjustments, and we're pretty good at it. Most of the time we wind up being within that, 3% or sometimes less of what the property sells for.
Nice.
provided the borrower sticks to their plan.
Yeah. And yeah, not only are, appraisals often $450 to $700 nowadays, it's also, I find it just a bit of a pain scheduling them with sellers, especially in our situation. We kind of pitch a easier service to sellers. So you might have an elderly seller who doesn't want people walking through the house. They're a bit of a hoarder. So it's it's harder to schedule that appraisal. And so being able to do it without always needing to physically get someone through the properties is a bonus. And again, it just saves the appraisal cost. So that's one of the advantages that we like. And I know on one deal you kind of saved our butt because we were working with a different lender, and they kept trying to schedule an appraiser, and the appraisers for some reason kept canceling on them. And so we got down to the last minute. They couldn't get an appraiser through, and I called you up and said, "Hey, I need help with this one, Rob." And we asked the seller, "Can you extend by a few days?" And the seller couldn't because the seller was closing on another purchase the same day. And you basically had one business day to get this loan together. I know this isn't what people should expect, this kind of speed, but you guys turned it around in, our lawyer was shocked at how quickly you guys were able to get it done. The lawyer you guys work with in Ontario kind of stayed late at the office to get the paperwork done in time. Like, everyone put out all the stops to get this done. So to get a private loan together, get all the legal work done. Obviously the lawyers I work with are excellent as well. Yep. So they're willing to put in that extra work, but to be able to do that last minute was pretty exceptional. And that property actually we're staging next week. We're going to be selling it shortly, but yeah, this summer you guys pulled that together for us in about a 24-hour period to get a loan start to finish, which was very, very impressive.
That's what we like doing for our awesome clients. And the more that you work with somebody, the easier it becomes to produce results. And I'm really glad that you hit on the lawyers too, because we got to do our piece as a lender, prepare the documentation, underwrite the file. It also takes a group of awesome lawyers. In our case, your lawyer and then our lawyer had to work together. So once you called me up, I was just lining up the lawyers and saying, "Hey guys, here's what's coming, get ready." So nobody's going to be shocked, and creating that alignment and saying, "Hey, this is what we got to do in the next business day. Let's do it."
Absolutely. Yeah. The lawyers you guys work with are great. I previously interviewed Mark Sosha, who's one of the lawyers I work with on this podcast
this morning.
Oh, did you? Great. Yeah. So yeah, he's one of the ones who can, I don't think he was the one who closed this deal, but he's one who'll put out all the stops to get it done, and great to work with. So, can you share, obviously things change depending on timing of the market, depends when this podcast comes out. And there may be specifics to a deal that could change it, but what would a typical cost be for a flipper to borrow, either with 20% down or with the minimum down?
Right. So good question. So we'll just talk about our flip product, because I think that's going to be what our audience will be most interested in. 20% down. So the cost of our capital will vary. Obviously, the less down increases the risk. It also impacts how we can margin our capital in the back end. So when you're working with alternative lenders, one of the things that the listener might be interested in is what it costs the lender to borrow that money, because the lender's money comes from somewhere.
Well, I thought you just had all of that money. That you were just rich.
Not yet.
Is that not how it works?
Not yet. We got to do a bit more business before I'm there. But I'm not stroking those kinds of checks right now. Hopefully one day. We keep working together, anything's possible. But so our capital as a lender comes from a syndicate of banks, line of credit. So we have a big operating facility we can pull from that. The cost of that capital is prime plus a bit of a spread for that. So what they're paying plus a spread on us. And then we also have shareholder equity, people that invest in our company that we're looking to produce a certain return for them. On the lower down deals where we're very highly leveraged, we can use less bank debt on that, and we have to use more equity to fund that loan. So it's more expensive. Conversely, if somebody puts more down, we can use more debt and less equity to fund that deal. So it's more efficient from a cost of capital perspective. So that's why whenever people are talking to us, they're saying, well, your 20K down product is more expensive. Yes, because it's more expensive for us. We also have a higher loss ratio, if you will, or I shouldn't say loss ratio because we don't lose a lot of money, but we have there's a stronger correlation between lesser down deals and problems than there are more down deals and problems, stated differently. So if somebody wants to borrow with 20% down, you're generally looking at right now an interest rate of 11.24. That's fully open, that's annualized. If somebody wants to go with 20 grand down, then you're looking at 18.24 right now. Again, annualized, not compounded monthly. The one thing that I talk to investors about, though, is that higher leverage product is designed for people who are maybe looking to scale their portfolio, or people who are looking to get into real estate investing and don't have as much capital. Because if you're doing a $100,000 reno and you're putting 20 or 25% down on a $500,000 purchase, and you're carrying, and you're closing, and you're operating, boy, you need to have around 300 grand kicking around. Not everybody has that. Not a lot of people do. What we're trying to do is reduce the barriers to people investing in real estate. We are an undersupplied nation in real estate. Last time I looked at the data, I think it was least amount of housing units per capita in the G7. Our population is, growing. We're bringing a lot of people here because we don't have a replacement birth rate. We have a depreciated housing stock. Moreover, revitalizing the existing housing stock rather is more efficient to improve the quality of the housing stock, in my opinion, because you could flip a house faster than you can build a new one. It's also more environmentally friendly, and you're able to preserve the character of the existing neighborhoods. So, it's gentle gentrification. Say that 10 times fast.
I thought flippers were evil people who were taking houses out of the housing stock and making them unaffordable, something like that. I read that on Reddit.
That could be a whole other episode. But I'll tell you this, the last time my wife and I bought a home, and the next time we're buying a home, we are looking at flips. I am really good at underwriting deals and looking at numbers and building spreadsheets and forecasting and blah, 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 blah. I am useless when it comes to replacing a faucet or replacing a roof or knowing how to GC that project. So I want to live in the inner city in a house that's been renovated. I don't want to fix her up her home. I don't have the time. I don't have the talent to do that. So I'm a buyer who's interested in that type of product.
We closed on a house a week ago. I think a week ago today, that you guys funded in Ottawa, condo townhouse. It had been vacant for somewhere between 6 and 8 years. Yep. The seller, I think what happened was it was an elderly parent who got sick, moved in with their daughter, and nobody went back to clean up the house. So it was a hoarder situation, but there was garbage bags full of food in the kitchen. The fridge was still full of food 8 years later. It was to the point that every surface in the house was coated with insect poop. There must have been, 5 years ago, there must have been thousands of flies on every surface in this house. And now they're all dead, long gone. But this was a townhouse that it just was sitting there for the longest time, nobody using it. And so now we're taking that, we're cleaning it up, getting rid of all the smells, fixing up everything that needs to be fixed, and we're going to get that back into the housing stock. So it's kind of what you're saying. We're taking something that isn't livable and hasn't been lived in, and we're putting it back in the housing stock, and I love doing that.
Yeah, it's, people need homes. It's, sprawl isn't inefficient. How should I say this? I got to be careful because I'm going on the record here. Sprawl doesn't necessarily create the most desirable housing stock because it's further outside of the city. People want to live inner city for a certain reason. We got a little bit off topic though, because you're asking me about the cost of capital. So, yeah, $20K down, higher cost of capital, but we're building that product we're looking to make the revitalizing existing housing stock more accessible. And we recognize that there's a need for real estate investors in our economy. They play an important role in the real estate industry. So we're trying to provide a service to them so they can be profitable and be rewarded for the fruits of their labor, while at the same time improving the quality of the housing stock for people who need to consume housing. The other thing I would say too about the the $20K down, nobody else does that to the best of my knowledge. And there's also, people who are looking purely at the sticker, the cost of the capital. Some people get put off by that. Other people see the opportunity in that. So The more that you lever as a business, the higher your ROI is, your return on investment. So some people, and we can work through all these metrics and we have them built into our tools, but the people who put less down actually are getting more return from their capital because they're investing less of it. Their capital is working harder for them. So depending on how we view the ARV and their business plan and the subject and the current market conditions, our underwriters will work through investors to make sure, hey, you're going into the deal with your eyes wide open. Here's everything that we see. Here's all of our work. Show us yours. Let's put together a structure that works best for your business plan, the property, and what we're seeing in the market right now.
And did you say 20% down was it 11.24? 11.24 and 20,000 down was 18.24.
Correct.
And that's with 2% fee.
2% fee. Yeah. And that's capped on in the mortgage. So with a lot of other alternative lenders and privates, you're going to the lawyer and you're having to pay those fees up front. That can be prohibitive in terms of being able to afford it, because in Ontario, you have your land transfer tax. If you're buying within the GTA, multiply that by 2. Then you have your legal costs. Then you have, your title insurance, which is included within your legal fee, but it's expensive. We're trying to, again, make an accessible product for investors to, create quality housing stock and a good living for themselves.
Yeah. The way I see the higher cost of putting less down, I think it really depends on the investor's situation. If they have enough capital to put the higher amount down and they only have the one deal available, they don't have another opportunity, so the rest of their money is going to be sitting on the sidelines anyways, put the larger percent down.
Yeah.
But if putting a larger percentage down means you only do one deal when you have 2 good ones available, or you'd be able to do 2 good ones, you're going to probably, assuming they're actually good deals, you run the numbers, you're going to make a better return doing the 2 good ones, paying the higher interest, than you would doing one good one, using more capital in it and paying less interest, right? So that's the way I view it. If you have more opportunities, it can be worth it because you make more return. If you don't have more opportunities and you have the capital to put it down, then go ahead and put it down.
Yeah. Also, what's your capacity to manage multiple projects?
Yeah.
What is the opportunity cost of putting all my eggs in one basket? It can also be a diversification thing too. So, when we onboard a flipper, we're going to be looking at their application, their credit, their business plan, what their history is, what their experience is. And we'll talk. Are you looking to do 1 at a time, 2 at a time? How do you manage multiple projects? If I see somebody that has a good amount of capital and they seem really savvy and pretty sharp, sometimes I'll say, hey, if you're also looking for that next deal while you're in this one, we don't want to have your capital all tied up in this one. And if we think it still makes sense for both parties, maybe let's talk about some of those higher leverage options to keep you more liquid.
Yeah, absolutely. So the market changed a lot in 2022.
Yes.
Interest rates started climbing.
Yeah.
It is funny because seeing the 11.24 and your rates were lower at the beginning of 2022.
899.
Sorry?
899 was that price point before.
Yeah. Well, nowadays, if you look at going to a credit union in comparison, if you looked then, you were at 3% versus 899. You're like, oh, that's 3 times higher. Now you're at a credit union, you're at like 8% anyways versus 11.24. It's not nearly as significant of a difference. It actually seems kind of cheap in comparison sometimes when you look at the ease of getting the funds. But the market's changed a lot. Interest rates have gone up. A lot of investors who were less sophisticated or overly
optimistic,
or had really only, overly optimistic because they'd only been through good times and expected the good times and the market going up forever to carry them forever. So some people got into trouble.
Yep.
Can you talk to us a bit about what investors you've seen, what mistakes you've seen that investors have made?
Yeah, I could talk about this for a while. So, the first 3 years of my career here at Calvert were really focused on originations, getting money out the door, and working with my team on that. Then when we came into that period of QT, quantitative tightening, it became strategic enforcement a lot of the time. We have certain borrowers who maybe over-leveraged, maybe misrepresented their assets to us, failed to disclose certain liabilities, which technically is fraud. but that's neither here nor there. So basically, some people might have taken on too much, or they did some tricky things. And maybe what I can just do is talk about some of the most common mistakes that I've seen. So the biggest one is not executing your plan. So when rates started to go up quickly in 2022, especially that hike in July when they did 100 bips, that really was a punch in the gut to many investors. I had some people who just didn't do anything for 90 days with their flips. 90 days, if you're doing your average flip, should be your renos are done within 90 days. So some people panicked, didn't execute their plan, then you've compounded that time. So if the market's going down, well, guess what? You're just going to take more of a slide on the downturn. It also exposed them because they're having to pay their alternative mortgage a little bit longer, and they don't have that renovated asset to sell. That becomes particularly more risky when you're levered higher. So if you have a 20K down house, you don't do anything to it, there's a bit of a correction happening. Well, if you still renovate the house, you're still going to be above water, and there should be some spread left for you. Is it going to be that home run, that 6-digit flip? Probably not anymore. But the more that people delayed actioning their plan, that there was a strong correlation with borrower loss there. The other thing I would say too is leverage. There's a lot of interesting money. I'll leave it there. Interesting money in Ontario. People think that Alberta is the Wild West. Alberta is very by the book from a lending and real estate perspective, in my opinion, in comparison to Ontario, because Alberta was pretty flat for a while. There were some corrections. Ontario only went up for the last 20 years. Generally speaking, there hadn't been a correction. So people were underwriting loans and lending money like there was no downside risk, that real estate only went up. And I say this because there have also been properties where borrower didn't do the renovations. Maybe they showed me money or showed my team money that they didn't intend to use for the renovation, and then they went out and got a second mortgage behind ours. So now you have a property that's levered 130, 140% because it hasn't been renovated, and there's a ton of money owing on it, and there's a second lender out there who doesn't really understand risk, and the investor doesn't understand that they're now liable to two different lenders who can take enforcement action on them. So I would say, misrepresenting and levering is another big one. And then tenants are a big one too. Say if somebody gets a property complete, I'm having trouble with cash flow because it took a little bit longer, I'm going to put a tenant in there and then market a property with a tenant. That is really tricky because you can't, unless you can guarantee vacant possession, which is even you put it on a contract. I've seen sales be frustrated because of that, because it wasn't able to be fulfilled. The LTB is broken right now, if I may speak freely.
I think everyone knows that. So
yeah. And it's really tough to vacate a tenant, especially if they don't want to leave. So people putting a tenant in a beautifully brand new renovated home to buy time, they don't make their mortgage payments, they can't get the tenant out. That's a really tricky situation too, I would say. And also location too. There is a period in time, say in 2020, late 2020, 2021, early 2022, you could flip in certain areas and not really do your due diligence. So when I say due diligence, you're looking at renovated comparables. What have they sold for? Are they like my subject? And we do that, a lot of that work for you, but sometimes people bring us contracts before we underwrite the deal. I'd call them speculators, and speculators play an important role in the market too. And we can touch on that later if you want to get my opinion on that. But people who are buying in areas that don't really have that population size or that population growth, there's not going to be the same demand for real estate in those tertiary markets, if you will. So those are the first areas where demand takes a hit. Then all of a sudden your seller's market turns into a buyer's market, your inventory shoots up, your days on market goes up, and then, your supply and demand, obviously when your supply increases, the demand will go down in some cases, and that is correlated with price corrections as well.
Okay. Have you found some people who had more issues? Was it more common in secondary, tertiary markets?
Yes. yes, that's why certain alternative lenders are very picky about the locations that they lend in. Population growth and population size are strongly correlated with the demand for real estate. If you're lending in markets that have had a flat population for the last 10 plus years, there's not going to be the same demand there, and when we were in that deeply negative rate territory and it was just drive till you qualify or just deal, get the property under contract and you'll make money. It doesn't matter, that whole insert the blank investor sentiment for a while. Some people got hurt in those situations. Fortunately, we didn't lend on a lot of them, but we've seen them.
Yeah, absolutely. Yeah, there was definitely some of that, especially some of the trainers were pushing just kind of tie up a deal and you'll figure it out later. And
yeah, and I'm against that. Do your diligence in advance. Ask the questions. If you're working with a realtor, if you're working with a broker, these are professionals that should work. Their whole MO should be to provide you with the information and then you make the decision. Don't be scared to put your realtor to work. So if they're telling you, I think it's going to be worth this when it's done, awesome. I really appreciate you sharing your opinion with me. Can you show me 3 to 5 comparables that are informing your opinion? Ask for data points to support whatever your professional is telling you. And if they can't do that, then maybe consider working with somebody who can give you that information.
And to be fair, I think everyone who wants to be a serious real estate investor, especially a flipper, needs to learn how to comp properties themselves. They don't have to become licensed appraisers, but comping's a bit of an art, a bit of a science. And to be fair, I don't think it's that hard. You just have to put the time in and practice, right? You can look at stuff that was just listed and go, let's see, it was listed at $699. Let me look at comparables to see what I think it's going to sell for, right? Now you look at houses near and say, I'm looking at the pictures of the other houses. I think this one's overpriced. I think it should have been listed at $649. I think it's going to sell around $640. And then you can, keep a watch on that, check on it, and 30 days later, it's still listed. 60 days later, they drop the price. Oh, look, it sold for $645. I was right. I think you can put in the practice, even if you're not specifically buying that property, you can put in the practice and almost quiz yourself. Like do practices on stuff that was just listed or things that people are projecting and what they're going to sell for. You can then look at that and see if you're going to be right. But you can practice it. You should practice it. I think relying only on a realtor to comp your properties, they're not going to put the time in and they're not the one putting their capital in. Yes, they're good and they can be kind of your final vet when you're actually buying something.
Yep.
But you can't expect a realtor to run comps on 300 properties for you when you're starting out and trying to start making offers. It just, you can't expect that of a good realtor.
No, and and like you said, it's not rocket science. It's especially when we're talking about entry to mid-level real estate, because this stuff should be turning over because there's people entering the market and downsizing to those price points. The quickest advice that I could give to anybody looking to comp their properties is there's a technique called bracketing. So you're going to have one property that's nicer, one property that's not as nice or as big, and then one that's pretty similar. So when you're looking at appraisal, your direct comparison approach, always try and find one better, not as nice, and one similar, because what you're trying to do is replicate the behavior of an educated purchaser. Not everybody's going to know what adjustments mean, but they can reconcile it in their head. Well, this property sold for $500, but it's a little bit smaller. This property sold for $600, but it's bigger and it maybe has some nicer outdoor features. Therefore, I'm somewhere in the middle. I'm probably worth somewhere around $545, $550 type thing, And if you can reconcile that in your head by bracketing higher, lower, similar to, it's not rocket science. You just got to be able to reflect the behavior of, somebody who's doing those reconciliations in their head.
That's amazing. Yeah, that bracketing, that sounds like an awesome way for people to think about it when they're comping properties, right? You're not just looking for identical properties.
No, make sure that it's apples to apples. So if you're looking at a bungalow, look for renovated bungalows. If it's a 1.5 story, look for 1.5 story. Semi-detached. Compare apples to apples, similar neighborhoods, similar lot size, similar features. And if you're able to do those things, you can, do that napkin appraisal, if you will, pretty easily. Adjustments, the more academic they become, and when I say academic, I mean backed by appraisal theory and formulas, the more complicated they are to the market. Therefore, just because something's true in a textbook doesn't mean it's going to play out that way in the market. Real estate is economically speaking, an inefficient good. It's not like we're trading a stock where everybody who's on the trading platform has access to the same information. We have buyers who have different levels of education, who have access to different information, who might have different motivations. And this can result in properties trading at different values to what one might think it's worth. So just because you have something that's backed in theory and you can go, yeah, this is good, I would submit this to my AIC, supervisor or, my professor at UBC, doesn't mean that a purchaser is going to do that. So,
And the market's imperfect. I mean, we see it all the time. You see, especially outliers. There's one property, condo townhouse that I was comping. It's a 2-bedroom, 2+1 bedroom, a comparable 2+1 bedroom, renovated, sold for $410, something like that. But a lot of the 3 bedrooms in the same complex are selling in the mid-3s, even some with decent renos. So that doesn't necessarily make sense. And I have a 2-bedroom. I'd like to think I could get into the 4s like that other one did when I renovated, but I'm not expecting it. I'm not running my numbers on it. That would be a bonus if I get there. It just, when you compare to everything else that's sold, even in the past full year, that one's an outlier. So if I can hit those numbers, awesome, but I can't bet on those numbers because it's an outlier and it's outside of the range that the other ones are selling for. And you can't expect that. So yeah, bracketing's a great way of thinking about it.
Yeah, it's simple, and it also keeps people from saying, hey, I'm going to be the highest priced house on the street or the block or in this neighborhood. Well, guess what? That is speculating because you're banking on a value that the market hasn't confirmed.
Yeah.
Now, pre-con, I love speculators, and I'll tell you why. If we don't have speculators, developers aren't going to put properties under contract or build them. So speculators contribute towards the supply of real estate, I would say, in that sense.
Agreed. Unless there's a different way to fund them. Right now, we don't have that. So
I'm in line.
Right now, we don't have that. So, so the issues you've seen are not executing on the plan, having too much leverage, tenant issues, and not properly doing their due diligence in the area. How much have you seen that borrower experience comes into play in terms of people who have issues?
Be greedy when others are fearful, and fearful when others are greedy. My better borrowers understand that. There's opportunity in all markets. Some of the lesser experienced people are the ones that are paying more attention to the headlines. When real estate's in the headlines, it's either you're never going to buy a house, or you're never going to be able to afford a house, or the sky's falling down. Values are down 50%. There's nothing in between. It's never good. So the lesser sophisticated investors, I would say, are more influenced by market sentiment. The more sophisticated borrowers are really focused on making data-driven decisions. Your podcast with Sosha that I listened to, you made a statement about making decisions based off of what is going to increase my probability or have me in the highest probability of being in a profitable situation. Paraphrased.
Yes.
And I think that's great. That should be the MO of any investor. You're never going to know what the perfect decision is. Perfect information does not exist. But what can I do to put myself in that best situation where I'm increasing my probability of being successful? That's the way that good investors think. They're understanding that in a down market, maybe they're going to focus on that entry to mid-level home because certain people who are in those tough, those higher end homes might have to downsize because their variable rate mortgage went up 40%, the cost of it. Luxury homes are going to be the first. So maybe you're changing your strategy in terms of the type of security that you're looking to invest in. Maybe you're really focusing on your A markets. So before you couldn't get stuff under contract, you're in that secondary market, that drive to qualify. Well, maybe you should shift and really get more selective on the type of security that you're looking at. Doing more due diligence in the comparables. Also, are you providing value for your seller? So maybe it's somebody who needs a quick close and you can work with them to write a contract. Maybe it's somebody who just got a demand letter from a lender and you want to help them preserve their dignity and preserve their credit. the sophisticated investors get that. They're finding ways to be easy to work with and create value for the other stakeholders in the deal.
Yeah. Something going back to what you were talking about on the thinking in bets kind of thing. There's also a concept that you see a lot of wealthy people, billionaires, multi-millionaires. They also take unbalanced bets. I'm not sure that's the right term, but they're taking bets. A lot of people think about it, okay, they think they're taking a chance on building a business. Okay, so I'm going to build this business. I'm either going to make $50 million or I'm going to lose $50 million. It's a coin toss.
Okay.
50-50 chance. But that's not how wealthy people think. They take unbalanced bets. So they're like, okay, I'm going to invest time and energy and effort into this. And there is a 75% chance that, I build a business that's worth more than $50 million and a 25%, 25% chance that it's going to be less than that. It's not proportionate where it's not 0 or 100 or negative or, positive. It's not a coin toss. They take bets where there's a very high chance they succeed and a very low chance of losing money or real failure. And failure in that case might actually just be, well, we didn't make as much as we wanted, but we still made money.
Right.
So it's not lose 50 grand on a flip or make 50 grand on a flip. That's not the risk. For us, our worst flip that we lost money on, and we did make a bunch of mistakes in 2022 and the market was changing. We lost 20 grand.
That's good.
Our best one was several $100,000. It's not proportionate.
Right. Like you're talking about hedging a little bit, and people, I was speaking with an investor yesterday and they said, hey, I don't want to do a flip unless it projects $100,000. I said, awesome. I love that you're being selective and, this is your investment criteria. Have you also thought about it this way? Not everything's, to use a very simple bastardized analogy, not everything's going to be a grand slam or a home run. There's nothing wrong with hitting singles, triples, or singles, doubles, and maybe the odd triple. But if you live in that single to double space, you're still going to be very successful. It's the people that swing for the fences, and that's where you can lose and really lose a lot of your money. And, if you lose your money as a real estate investor, well, guess what? You got to raise it all over again because you're out of the game, because you still need, a decent amount of liquidity to play this game.
And that brings the concept of risk-adjusted return, which some people don't get. Someone might be like, I have to make 100 grand on a deal. Okay, so I'm going to buy a very rural mansion with no comparables and have a huge renovation budget. And if it works out, the numbers project over $100,000 in profit. It's great. Well, what if you were taking a much smaller profit, 30 grand, but it's a low-priced condo townhouse. They sell like hotcakes all day long because it's an affordable product. You don't have to worry about the windows, the heat source, the roof, the insulation, any of the exterior, because that's all maintained by the condo corp. So you've just got a slight cosmetic reno on the inside. You've got 20 other comparables that have sold in the past 6 months or a year, and they're selling quickly. That's, when you adjust for the risk, that's a much less, like your return is actually probably higher on that because you're not taking the same kind of risks. When you try to get only high numbers, but you're willing to take a lot of risk to get there, you may end up on a risk-adjusted basis in a worse position.
I love how you're talking about risk because not a lot of people do that risk audit on their deal. What is the probability and what's the impact of this risk? We talked about people having access to different information, but that, analogy of your townhouse versus your acreage with no comps, that's a liquidity risk. So if you're swimming in the market with the most buyers, when things get tough, your rural property that's priced high, people aren't buying those. People that are coming new to Canada or that are buying their first home or that are downsizing, work in a market where there's demand coming from both up and down. I love everything that you just said.
Well, before we shift to the next section of the show, can you talk a little bit about what areas you guys lend in? So if I have a lead on a property that's 2 hours north of Saskatoon in a town of 1,200 people, will you guys fund that?
Regrettably, we would not. Our lending right now is in Alberta and Ontario. we like urban areas. So we define urban as anywhere with at least 10,000 people within the city limits, 50,000 people, 10 kilometers within the city limits, or 100,000 people within 25 kilometers of the city limits. This is our lending criteria as it relates to portions of our capital and the rules that they tell us and how we can deploy it. This is also great. These are also great guidelines for real estate investors, because if the banks are telling us that they only want to lend on those properties, well, maybe they're only approving mortgages in those areas, or maybe those people are the ones that they're getting approved easier.
Absolutely. Yeah, that makes sense. And if someone is looking to do a flip before they go and make offers on a property, can they reach out to a lender like you guys, make sure that they would qualify depending on how the property is?
Please do. Reach out to me in advance. We will underwrite the whole deal beforehand. So depending on what your plan is with the property, what your available capital is, we'll give you what I call offering parameters. So you know what your position is relative to certain down payments. That way, when you get negotiating with a wholesaler or somebody on the MLS, you're not going back and forth with your lender. You're going to have it all in a spreadsheet or all in an email, so you know exactly what your checkout point is. And it can allow you to kind of create bully offers sometimes too. We work with a lot of wholesalers. Luke's team is my favorite, not just saying that. And some wholesalers like knowing that their buyer is real.
We absolutely consider it, especially if we have more than one person offering on a property and maybe we haven't worked with them before. But, they've told us, oh, I've spoken to Calvert. They've already approved me, depending on looking at the specific property, but they've already okayed me as a borrower. And then, with their permission, you guys will agree, confirm that. That gives us a little more strength that we're not going to have an issue with closing because, they've already been vetted from a financial aspect. So that helps for us as a wholesale.
Yep.
All right, so let's move on to the next section of the show. Now, usually this is the part where we talk about the best and worst deal with real estate investors, but since we're talking to Calvert and you, Rob, I wanted to talk a little bit about kind of some of the best and worst deals you've seen come across your desk, the biggest problems you've had come across your desk and the lessons you've learned from that, because the point of looking at the best and worst deals is we are looking to see kind of what mistakes were made, what we can learn from and do better, or our audience can do better next time. So either for you guys, kind of mistakes you guys made underwriting it or choosing to lend on it, or kind of the biggest mistakes you saw in a particular deal made by a borrower.
Yeah, so I think we'll start with underwriting mistakes. There's two different types of failure in a loan, I would say. And one is an underwriting mistake, in that we looked at the box, or we looked at our lending standard, our rules, or our qualifying criteria, and we made a mistake there. Or there's borrower mistake. This can be them not doing what they said they were going to do, them spending money elsewhere. One example of borrower mistake is, let's call it life event is death. While I did a deal in Alberta, the property got demolition. It got demolished all the way down to studs, and
by the borrower.
By the borrower.
Okay.
And then they died.
Oh.
And then they started missing payments after a little bit, and that was a tricky file because that was a life event. Other life events can be job loss, marital, health, something that, impacts your income or your ability to execute your plan. One of the things that I would say is, some underwriting mistakes that I made earlier in my career would have been around extending a certain amount of leverage to certain clients, where they're performing good enough in that they're making their payments, but their 90-day flip is taking 7 months. And then they start buying more property, and they show you enough capital, and they show you, it still fits, but it doesn't make you feel good. When I was younger, I would say, well, it still fits all of our rules. They've showed us enough money, but it was the performance piece that I would say is lacking. We didn't have enough documented performance to extend certain credits. So a lot of repeat borrowers got into some tricky situations because They were buying more than they had the ability to manage. And then they had a bunch of half renovated properties that didn't pan out the way. So I'd say that was kind of an underwriting mistake for me is, how do you track performance and how do you balance the client's capacity to execute versus what your rule book is as a lender? How do you marry the two? Knowing at the same time, mortgage brokers are a lifeblood of your business. So sometimes it's tough to decline a deal when somebody who brings you a lot of business and is very valuable to your firm brings you a client who's performing okay and they know it fits all your rules, but you're declining it on a reason that's kind of weak. That's a tricky spot as an underwriter to be in. And learning how to say no because we haven't seen this kind of performance or because, they haven't done what they said they were going to do to the perfect degree. We want to see them perform better with our capital before we, give them more. I think that was an underwriting mistake that I'd made.
Makes sense. Okay.
Borrower mistakes. So we touched on the few, executing, learning, or leverage, tenants and due diligence. Some of the worst deals. I got to be careful with how I say this because I don't want, there might be some potential listeners who could be affected or involved in some of these deals. I've had borrowers send in, sometimes when you get in a tricky situation, they start missing payments. What I'll do is I want to help them build the property up. Any lender with half a brain knows that it's better to have something secure. One, so you actually have a realized asset that you're secure on, but two, we're in this for the borrower too, first and foremost. So if we can help them build up the property so they have something to sell and put some money back in or lose less money, heaven forbid, that's better than enforcing on something that's half built and demolished day one.
Uh-huh.
So, what I'll do sometimes is, and I won't tell you how I get all the way there, but we'll do progress pictures in lieu of payments. If we see that they have credit and they have the ability to get the security built or realized, I'll give them a payment holiday, not forgive the payment, but payment holiday if they can show me that they can get the property complete and market it and sell it subject to a bunch of other things. I have had people send in fraudulent pictures.
Oh.
So of course that changes how you underwrite that. So rather than just getting me pictures, maybe I'm sending a third-party inspector to meet you at a certain time. Or if you're at the property, maybe you're getting on FaceTime with me, I'm recording it, and I'm seeing you go in the house, and I'm matching that with the records that I have on file to confirm that it's the property.
I don't think fraudulent payments could be a different property. What we see often on renovations too is, especially when it's remote, a contractor might just take pictures close up of different areas.
Yep.
But you don't get the whole space, and there's a they take a picture of one area and that wall has backsplash tile, but if you look at the whole kitchen, all the rest of it doesn't.
Yep.
Or, that kind of stuff. So they just there's specific stuff they can show as well that can make it trickier. So yeah, something like a video walking through makes sense.
Video walking through, or they're, like we said, different property. Date stamped pictures are a really good idea too. I've seen some flippers, they'll say, hey, I'm meeting with my contractors every Friday at this time to show me what they're done so they can get their paycheck.
Hold up a newspaper.
Yes, like something like how are we auditing the date and the time, right? There's different ways to go about that. But the worst deal, a house that was intentionally flooded, I would say.
Oh, by the borrower?
Figuring that piece out. But there's a house, and I'm not going to say what province, but there was a sale in play. And I was working to determine if it was arm's length with some people that we've had some issues with. And we did our inspection, and it was flooded intentionally. And yeah, that might be one of the worst ones.
Interesting. Flooded intentionally.
Yo.
Was that supposed to be for an insurance claim or to get out of the sale?
I think to collapse the sale.
Well, I wonder if insurance could have come to help make that better.
That's another issue. I think there might have been a forged policy as well.
Oh, wow.
Yep.
Oh, wow. Okay. Well, okay. When you were talking about someone who demoed the whole interior of the house and then died, it reminds me of a friend of mine who thankfully is in good health. but he closed on a property. He lives in Oklahoma City. Closed on a property that was demolished like the day before he closed by the city. Like it had I guess an order to repair it, and they didn't do it, and it got I don't know how it turned out from a legal perspective, what happened, but the house was torn down.
That would be a matter of contract law to me, I think. Because
and I mean, it's in the States, it's different. But I thought that was, he posted a video on his Facebook about, he showed up, he's like, I closed on this house, and the house wasn't there anymore. I mean, the good thing too is he was probably going to break even just on the land. And I think he was going to be sent the bill for the demo from the city as well, which was...
That's a due diligence thing though too, right?
Yeah.
Like if you're buying property, this is where it is.
Yeah. Like this guy, great realist. He's been flipping a long time, really knows what he's doing. He actually specializes in a lot of fire damaged homes as well.
Okay.
Really knows what he's doing, but yeah, it gets tricky. So let's talk about some of the best deals you've seen. If you want to think of any examples, best deals for you as the lenders and maybe for the borrowers as well.
One of the first deals that I underwrote here a few years ago was a BRRRR. Within, I think it was like 92 days, they bought the property, renovated it, and pulled out $250,000 after the fact. So that was a really cool case study. The takeaways there were they just did what they said they were going to do and do it. Then they did it really quickly, which was really good. One of the more memorable flips for me in 2021 was a guy, I touched on this earlier, took keys, gave the keys back, 21 days. That was a really good success story. I've observed why you and your business are so successful, so I'll leave that there. You guys perform continuously, and it's a lot of fun to observe that. Not even just flips too. But I've been in situations where, we have this product, lending product, if you will, called interim purchase, where we lend on the market value of the property, not necessarily the purchase price. Pre-con, family split, husband and wife got divorced, no longer had the down payment to qualify conventionally. We were actually able to lend on the property with 20 grand down, and then they refinanced conventionally after 120 days off the appraised value. So I'd call that a really good win. She was punished. I don't want to say punished, but her ability to qualify conventionally was challenged. Didn't have all the money to put down anymore because it became a little bit litigious. But they kept the home, refinanced it out later, and actually kept more money back in their pocket too.
I think that's something great about Calvert is that you guys, a lot of private lenders, in my experience, have trouble understanding that what you pay for a house isn't always the market value of a property.
Yeah.
A lot of just people in general, appraisers all the time. They just assume that what you paid for the property is what it's worth, and then they go and try to justify it with comps to try to explain why you paid so little for a property. Yeah. So that's a difficulty I've had in past years with private lenders, and that's something good about you guys is you understand, well, just because they paid this, maybe a pre-con a few years ago, it's worth a lot more now, so we actually have equity there, even though they haven't put money into it. I think that's a great way of thinking about it.
Yeah, it's, we want to reward people for buying well, because that takes our risk off the table too.
Absolutely.
Like I've done a lot of those deals where family situations change from purchase to closing date. Can we help that person qualify or resell for a profit and save their deposit and get a home? Sure, why not? People deserve it.
Yeah, awesome. All right, we're going to move on to the final questions since we are running out of time.
Perfect.
First of all, Rob, what's changed about your approach to underwriting and lending with your experience?
The only constant is change, I would say. When I cut my teeth in this industry, I was writing $20,000 seconds, and your average exposure period for a property was 90 to 120 days. And then we went to Ontario, and I got my first appraisal back because we needed appraisals there at first, and I saw 4 days on market, and I called the appraiser and I said, I think this is a typo, and they laughed at me. So, my biggest changes in underwriting, I would say, is, always being open to new data, not being used to how a particular market had performed. The only constant is change, and you just got to wake up every single day and every single deal when you look at it, absorb the information that you have, and make the best decision with the information that you have in front of you that day. Don't get used to a certain market, or don't try and tell yourself, oh, the good old days, or when rates were this, or when this was doing that. It's just every day, collect new information, make the best decision then.
Sounds good. Awesome. Okay, next question, Rob. If you could go back in time, what's one piece of advice you'd have for a younger you?
I don't live with many regrets. I have a good career. My wife's way better looking and way smarter than I am, so I did well there. Maybe I would have gone back to school sooner. So I redid school in my 30s, which was a lot of fun. But I was also up all night studying, trying to start my career in lending at the same time. So maybe if I could go back in time and redo something, it would have been using those beautiful CFL off seasons when you have so much time, you don't even know what to do with it. I would have pursued more academic endeavors at that time rather than launching my second career in my 30s.
Nice. That makes sense. Okay, and final question. What do you believe is the most overlooked or the most overhyped real estate investing strategy right now?
Again, I got to be careful here. I'll say overhype. The whole mentality of just getting a deal under contract. The presence of a contract does not equal a good deal. A good deal equals a good deal. So I'd say overhyped is, it's really good to, fortune favors the brave and the bold. We all know that. I've also seen people lose a lot for being a bit too brave and a bit too bold. Anytime you get a deal, and if it seems too good to be true or not, just scratch that. Do your due diligence on every deal,
Yes.
Old school due diligence, comps, understanding your position, understanding your investment criteria, i.e. what you want to make in that deal. Good old-fashioned due diligence and doing things the way that experienced investors have. Work with an investor who's been through different terms and been in the game for a while. If you're working with somebody who doesn't do what they're telling you to do, or they haven't underwritten or done deals through different markets, maybe you got to question some of that motivation.
Yeah, absolutely. Due diligence is so important. And I love how you said scratch that too, if it seems too good to be true. Because it's funny, the response I've gotten multiple times. Sometimes I tell someone what I paid for a property and they ask me, well, what's wrong with it? Like, oh, you got it so cheap, it must be really bad. But what if I paid a lot for a property and there was a lot wrong with it? You should be doing your due diligence on every property. And just because the price is low doesn't mean it's too good to be true. You might have actually gotten a really good deal, or you might have paid a lot for a property and actually gotten a lemon, which is way worse than paying very little for a property and then having some issues to deal with. I'd rather pay too little for a property that people think there's something wrong with it, and then if it turns out better than you expected, you're doing even better than you planned, as long as your due diligence was expecting issues. So, all right, Rob, thank you so much for joining us and for representing Calvert here. How can people find out more about you? How can they get in touch with you or with Calvert?
Yep. So we're on Instagram. You can look us up at Calvert Home Mortgage. You'll find us there. You can also reach out to me. My email is rob@chmic.ca. If you have any questions about flipping, or anything that you think would, purchasing strategy that would benefit from quick capital that can really provide you that white glove service, helping you underwrite the deal and sharing that with you, drop me in line. It would be great to connect.
And there is also a discount if you off your 2% fee if you mention that you found out about Calvert, or just mention my name or Bliss to Calvert, and they'll take $500 off of that 2% fee.
Yep. If you work with Luke and if you came to us through Cash House Buyer, just let me know and we can coordinate that for you.
Awesome. Thanks so much for coming on, Rob. I'm sure we'll be talking again soon.
Awesome. Thanks, Luke.
Take care.